Good morning, guys, and welcome to the Camp Financial Stock Market Update. Today is March 22nd, Wednesday. Um, so we haven't been doing videos back-to-back days for quite some time, but after the big sell-off in the market yesterday, I want to get on and just kind of go over what happened and kind of look at the three different types of investors that you see when the market sells off like this. Um, you know how they react. Your reaction to a sell-off is more important than really than what you do when the market's going well. So when the market's doing well and it's up and everybody's happy, right? Everything's easy. It's how you react to downturns, how you react to when stocks turn against you. That's where you make your money, specifically as a financial advisor. That's what we're here for, is to assist people when the markets are going down, help them to not panic and to continue to focus on the long-term goals. So all right, with that said, let's take a look. So let me see if I can see the full S&P 500 from yesterday. I don't have it here. Okay, so the Dow was down about 1.14%, NASDAQ down 1.82%, and the S&P down about 1.24%. Basically, the S&P down was primarily driven by the financials, the money center banks. So Bank of America was down almost 6%. I'm not sure which one. Comerica was down 6%. Some of the other ones, JP Morgan down 3%, Wells Fargo down 3%. Looking at Goldman Sachs down almost 4%. Morgan Stanley a little over 4%. Schwab down a little over 4%. There's definitely some pain in the tech as well. Obviously, the NASDAQ down as heavily as it was yesterday. The major airlines were down. Really, we're pretty much down across the market, right? So we've got a few spots: consumer goods, beverage, soft drink beverages, Coke, Pepsi, performed pretty well. Dr. Pepper, Snapple. Looks like Monster Beverage might have been the only one that wasn't up in that sector. And then we got utilities. The electric utilities all up yesterday. That makes sense, right? So when the market sells off, when people are afraid, they look for bond equivalents, companies that are going to pay a strong dividend, that have, that have the pricing power. The companies that they're always going to be able to collect, their electric bills. So if they can collect their electric bills, they can continue to pay dividends to the shareholders. It's kind of a recession-proof business. It's not. If a true recession would hit, I think they would definitely, feel the pain as well. But it's the most stable long-term business out there, in my opinion. So utility stocks all up yesterday. So I just want to run through all of those. So I mentioned Bank of America. Bank of America is one of our holdings. Go back in, give me a second, and I'll tell you. I'll pull up my spreadsheet. Because yesterday I think I mentioned Bank of America was currently we were up like 50-some%. So now we're up about 44.5% since we bought it. And we still got our stop in place at a little over $20 a share. So even if it goes bad for a few more days, we're still looking to get out at around 20 bucks a share, a little over, actually about 20 and a half, we're still going to get out with a 28% gain if it just continues to rip against us. Now if it flattens out, then we continue to hold, collect the dividend, and let it keep running. So, that's why, as long as you have those stops in place, or you have specific ideas of when you're going to get out, a big down day in the market doesn't panic you, because you know what you're willing to lose and where you're going to get out to protect yourself from losing more. So, like I said, so that's kind of, I mentioned, so there's three types of investors, in my opinion. One, you've got your investors that just stick their head in the sand. They're probably the second best type of investor. One is more the style of your of the way your financial advisor should work, and that's they got a plan in place. They know what they're willing to, where they're willing to get in, where they're willing to get out, and they have very tried and true rules as to how far they're going to let things go. The third is the type that panics on a down day. Market's selling off, they panic, they sell out, and they felt so much fear in the sell-off because they didn't have those rules in place that now they're afraid to get back in. So yeah, the three types of investors: one sticks their head in the sand, and when the market goes down, it goes down, and they don't worry about it, and then it comes back, and they get what the market gives them. The second has a plan. They sell out of certain stocks when they sell off, but they have a plan as to what stocks they're going to get into if the market does sell off, or if their particular stock sells out. They sell out of it and they have a replacement ready. The third, they panic, they sell, then they're afraid to get back in, and they miss, you name it, on the upside. So a lot of people sold in 2008 when the market was clear at the bottom, and they were afraid, and they were afraid, and they were afraid, and they didn't get back until 2015. And yeah, so in the last couple of years they did pretty decently, but before that they missed out on almost doubling their money. So that's why, in my opinion, you set rules. You know how much you're willing to risk, you know how much you're wanting to make, and then you just let it go, and you got to keep a thumb on it. You got to keep a thumb on the pulse, figure out what's going on. But while things are going good, you let it go. When things go bad, you let it go until it hits that rule that tells you, ooh, okay, now it's time to get out of this one, because obviously things have happened that now what my original thesis was probably isn't going to play out. And the other side of that is understanding fundamental analysis. Maybe we'll go into that a little more going forward. Being able to analyze a stock and look at a stock and say, okay, what's the story? Why is it doing what it's going to do? If the story continues, this is where it should go. If the story falls apart, you listen to the conference calls, you listen or you read the annual reports, and you say, ooh, the story changed. Let me analyze it. How's that going to affect where I thought this stock was going? And if it tells you that the stock's not going to go up like you originally thought, or it's going to go down, it's time to get out. So, alright guys, that's it for today. Take care. and we will see you next time.